Hello, everyone, and welcome to Think Well TV. In this community, we're here to get wealthy. With that being said, in this video, like all the other videos we shoot, we are going to have to go deep into detail. With that being said, if you notice, the thumbnail on the left-hand side is orange. That's for opinion-based videos. Green is for portfolio-related content. Blue for educational videos. Make sure to check out some of our other videos, and please subscribe, like, hit notification bell, share this video with everybody you know. Alright guys, I wanted to shoot this video all in one take, but it'd probably end up being about 35 minutes long, so I'm splitting it up into two parts. That way it's easier to digest for you guys, because it's a lot of information. So today in part one, we're going to be going over the three biggest bank stocks, the ones I hear the most information about, the ones that people are talking about the most. And then in part two, which is coming up shortly, we're going to talk about different bank stocks that I like more, that are more geared towards dividend investors. They have better yields, they have better track records for dividend payouts, and things of that such. With that being said, if you guys have not signed up for Robinhood, there's a link in the description below for a free stock. I don't know what you guys are waiting for. Let's jump into the video.
Alright guys, we're going to start with JP Morgan, ticker JPM. This is a very big bank. It's sitting at a market cap of $308 billion right now. So even with the stock being depressed, you're still sitting at $308 billion market cap. So it's a big bank. With financials in general, they're down quite a bit. They're a cyclical industry in a sense, because when interest rates go down, all the financial companies tank because they're not going to make as much money as if they would if interest rates were high. So you can make a lot of capital appreciation on the stocks, plus you get in at a great entry point, and you also make the dividends. So a lot of pluses right now for our banks. If we look at the 52-week high, it's $141.10, and the current price is $101.07, as you can see over here. If we take the 52-week high and we take the current price, then let's say in theory that maybe in a couple years things recover, interest rates recover, and JP Morgan hits its 52-week high that it did this year. In that case, we'd be looking at a 39.6% gain in capital appreciation. So that's pretty good. Let's look at the dividends and see how those look. If we look at the dividends, it has a yield of 3.56. That's not bad. Payout ratio, 64%. That's not bad. So then you can look at the 5-year CAGR. That's 16.17. But the thing with banks is the 3.56 seems like a decent yield, and the payout ratio does seem safe. But the thing with banks is in 2008, a lot of them cut their dividend. So just because they haven't cut their dividend yet and the payout ratio doesn't look bad and technically it's safe, what I've noticed from this pandemic that's going on right now is a lot of companies seem to cut their dividends fairly quick. It wasn't like 2008 when things just kept getting worse, and then 2009 was worse, 10 was bad. Then companies like, okay, we're going to have to cut the dividend. A lot of companies, from what I've noticed, are very quick to cut their dividends this time around. There's just basically no warning. Okay, if we look at the dividend history, it doesn't look too bad starting off, but as you can see, they cut the dividend on 4/1/2009. It took about, dividend was at 38 cents before the cut. It didn't recover back to 38 cents until 7/1/2013. So it took about 4 years and 3 months for that dividend to recover. That's not too bad, but it still kind of sucks if you're a dividend investor going from 38 cents a share down to 5 cents and then having to wait over 4 years for that dividend to go back to where it was. So that's just something to consider. If you're investing in these companies and you're a dividend investor, yes, the dividend looks safe right now, but in theory, there's a good chance the dividend could get cut. I don't see it getting cut personally, but there's a lot of companies that I didn't think would cut their dividend, and they did right away. Who knows what's going to happen in a couple years? Maybe we'll have another recession, things will tank more, and if the banks never fully got a chance to recover, the dividend's probably definitely getting cut then. All right, guys, now we're on Bank of America. This is Warren Buffett's stock right now, as in the time of shooting this video. So this is the bank he's going heavy on. I'm not sure why he's going heavy on it. It's not a bad bank. I mean, nothing looks bad, but I don't see anything spectacular to me. If we look at the market cap, it's in at $220 billion. So this is a big bank. Not as big as JP Morgan that we just looked at, but it is a big bank. We look at the 52-week range. The high is 35.72. So again, if we look at capital appreciation wise from this bank, from 25.50 to 35.72, if it got back to that high within a few years, you will make 40% profit in capital appreciation plus the dividends. So that's about the same as JP Morgan. JP Morgan was 39.6. You're looking at 40% with Bank of America. So they're basically exactly the same. All right, as a dividend standpoint, the yield is 2.82, but the payout ratio is 46.04. So basically, if we up the dividend 50%, we'd be looking at a 4.23% dividend. If we up the payout ratio by 50%, we'd be looking at 69.06%. So it's a little bit higher than JP Morgan, the payout ratio, but the dividend would be quite a bit higher. So the dividend yield isn't bad, and it's a little bit safer. In comparison to payout ratio, Bank of America is a smidge better than JP Morgan, but I still prefer JP Morgan. I think JP Morgan's a great bank, but they're very, very close. Looking at dividend history, as you can see, the dividend was substantially higher in 2008 before they cut the dividend. And as you can see now, it still hasn't recovered. That's something that happens with banks sometimes. And it's something, if you're watching this, to kind of consider, especially if you're a dividend investor. There's a chance that that dividend is going to get cut, and you don't know how long it's going to take for that dividend to recover. I imagine eventually, as long as Bank of America keeps paying dividends, it will recover. But I mean, is it going to take 20, 30 years? They cut it in 12/2/2008. That's when the dividend had the first cut, and then it got cut right again. So if you don't want to count that one, you count the one at 3/3/2009. As you can see, we're into 2020 now, so it's basically 11 years later, and the dividend's not even close to being where it was at. So is it going to recover in 20 years, 30 years? Who knows? That's something to consider with some of these big banks, is that dividend history. The best way to predict future behavior is by looking at past behavior. So when we look at this past behavior of Bank of America, yes, management could change, but there's a good chance they'll cut the dividend again. The streak hasn't been going on that long. All right, guys, I forgot to mention too, the 5-year CAGR on the screen we were just at was sitting at 40%. Now, 40% 5-year CAGR looks phenomenal. So a lot of people too that look at the dividend growth aspects of stocks, as you can see, the numbers look great, but they're not really doing a whole lot right now, especially when we look over here at these dividends. I mean, 18 cents right now, 40% CAGR does not look good when they're this low. And like I said, they could cut it again anytime. So that's something to consider when you're looking at bank stocks. Now we're looking at Wells Fargo. This is kind of a controversial bank. I think some people don't like it, so there's too much risk. I don't think personally there's that much risk with Wells Fargo. Yes, they had the whole scandal. Yes, the scandal was bad, guys. I think banks as a whole are kind of dirty, and I think banks probably doing a lot of scandals and they're just not getting caught. But it doesn't mean it's okay. Doesn't mean it's good. It's bad. Let me just make that clear. But Wells Fargo took a hit when that whole scandal came out, and it probably should have. I think it took a big hit. I don't know if it should have took that big of a hit, but now it's an even bigger hit. Wells Fargo does have new management, but this is something I want to bring up to you guys. We look at the market cap, sitting at 100 billion right now. The stock is way down. So this bank is quite a bit bigger than 100 billion, I think, even at its current state. But that's being priced at $24.27. I think it's extremely undervalued. Now, if we look at the 52-week high, it's 54.75. Now, if you remember, JP Morgan, 39.6%, right? That's how much you get in capital appreciation from the share price if it goes back up to that 52-week high. Now, if we look at Bank of America, it was at 40%, remember? So if we look at that 52-week high, sitting at $54.75, and we look at the current share price of $24.27, The potential, if it got back up to that 52-week high, which I think is very possible, some analysts believe it'll get up to $65. It will take a few years, like the rest of the banks, but it dropped down to about $50 a share when that whole scandal came out. So I could see it going up to $60, $65 a share. But even sitting at that 54.75, we're trying to compare apples to apples. We're comparing it just like the other two banks. You're looking at 125.5% gain in capital appreciation. 125.5%. That is huge, especially when you compare it against 39% and 40%. That's dramatic. So definitely, there's a lot of upside with Wells Fargo's. So if we look at the dividend yield, it's not correct. It's not 6.72%. It's actually 1.64%. So normally Seeking Alpha is my go-to website. It's a great website, and usually the numbers are dead on. A lot of the numbers that are off, in my opinion, come from Yahoo Finance. So I always have to double check Yahoo's Finance's numbers, but in this case I have to double check Wells Fargo's. So the dividend yield is not the 6.72, it's a 1.64%. Annual payout amount is not $1.63, it's 40 cents. Payout ratio they have is 919%. That is not right either. That is really bad. Let's look at the actual payout ratio. All right, guys, so we're at the quarterly EPSs for Wells Fargo. If we look over here, because you want to look at the last 4 quarters, the first quarter would be 9/3 of 2019, and then it'd be 12/31 of 2019, it'd be 3/31 of 2020, and 6/30 of 2020. So these are the EPS for the last 4 quarters right here. If we add them up and we divide it by that 40 cents they're paying, you get a payout ratio of 44.4%. So the payout ratio is low, but if you compare it to Bank of America, which is at 46% and paying you 2.82% versus the 1.6, Bank of America, from a simple dividend aspect, does look better, but Wells Fargo already got that huge cut out of the way. Most people predicted a 50% cut. I don't think anyone predicted a 75% cut. So that dividend's huge. The dividend cut is huge, but it's out of the way now. I really don't foresee another cut after that kind of cut. Should be safe from cuts now, I would assume. But Bank of America, JP Morgan, Bank of America looks pretty good. Who knows what's going to happen, though? Same with JP Morgan. JP Morgan isn't as good a spot as Bank of America in relevance to payout ratio. So JP Morgan probably in theory get cut before Bank of America, but you never know with what's going on right now who's going to get cut and by how much. Now we're inside the Wells Fargo's dividend history. The 5-year CAGR was like 7%, according to Seeking Alpha. I did not check that out to see what it actually was, to be honest. I'm sure that number's wrong. But inside the dividend history, we can see Wells Fargo again. Same story, JP Morgan and Bank of America. They did cut the dividend. They cut the dividend 5/5 of 2009. And before it was cut, it was at $33.82. So it didn't recover until 5/6, 2014. So that took a few years too. That took about a little bit longer than JP Morgan, but it did recover. A lot better position than Bank of America by far. So looking at the histories, Wells Fargo took longer to bounce in comparison to JP Morgan, but they did pay a bigger dividend. So they do push the dividend more, in my opinion, than JP Morgan. So again, we talked about 125% possible capital appreciation from Wells Fargo. You're also going to probably, once it recovers the dividend, you're going to get paid a pretty healthy dividend at a good yield. We'll see how long it takes to recover. I'm hoping if JP Morgan and Bank of America don't cut their dividend, Wells Fargo will raise their dividend extremely fast back to where it was. That's just a hope. No guarantees there. I own 40 shares of Wells Fargo, and my average cost is somewhere around $24.19. That's what it says in my Robinhood. Now, I did do some contracts through options, made some premiums there. I've done some trading with it, so I'm not sure exactly what my cost basis is, but it's somewhere around the $24.19. Once Wells Fargo hits $50, might take a few years, plan is to sell 10 of the shares. So I have a little under $1,000 in it now. when it hits $50 a share, I'll have $2,000 in Wells Fargo. When I sell those 10 shares, I will pick up $500. So I own 30 shares now that are worth $1,500. But really, after you take off the $500, I only paid $500 for 30 shares of Wells Fargo, and they're worth $1,500. Once it hits $55, I'll probably sell another 5, and then once it hits 60, I'll sell another 5. After that, I'll be left with 20 shares, and I would have made over $1,000. So that means those 20 shares would be free, and I made some profit, and I've made dividends. That's my plan with Wells Fargo. That's just another way to look at investing when it comes to stocks, because if I have those 20 shares for free and the stock just tanks, it's not a big deal. They were free. I can sell anytime and I'll make profit. If it goes bankrupt, Wells Fargo, I still made money. That's the beauty of it. And like I said, it's just another way to look at investing, guys. It doesn't have to be with banking. It can be with other stocks. If you get them cheap enough, maybe you do some trades, maybe do some option premiums. I don't recommend trading, but if you did, I would do some swing trades maybe. But again, I don't recommend trading, but you could do the options and collecting those dividends. Over time, you might end up getting shares for free, basically.
Wow, guys, that's a lot of information there. The 3 banks that we just talked about, JP Morgan, Bank of America, and Wells Fargo, I think personally, JP Morgan and Bank of America are very similar. But out of the 2, I prefer JP Morgan a little bit more. Reason being, 1, JP Morgan is a little bit bigger bank. And then 2, its dividend yield's higher. And 3, its track record's better. Yes, it did cut the dividend back in 2009, but in a few years, it got the dividend back to where it was. And then it also surpassed it versus Bank of America, which did not. Bank of America cut it. They did raise the dividend some, but it's still not where it was before. And another thing, Bank of America does have a better payout ratio. The dividend does look a little bit safer, but overall, they're close tie, but I would choose JP Morgan. When it comes to Wells Fargo, I think that is basically a gold mine for capital appreciation. You could easily double your money, in my opinion. Yes, things could change. I could be wrong. Remember that, guys. But I think personally, Wells Fargo will double in price, and you can make some good money when it comes to capital appreciation and still collect some dividend. Right now, the dividend is terrible. In my opinion, it's very low, but you can still collect that dividend. Those are my opinions. And guys, if you've made it this far, please subscribe, like, hit the notification bell, share the video, and remember, guys, as always, think wealth.